Welcome back to the channel. Today we're exploring one of the most consequential economic shifts happening right now in America, one that's quietly reshaping the real estate market and threatening trillions of dollars in property value. We're talking about the silent collapse of American housing in disaster-prone regions. Here's the brutal reality. More than 1 in 4 homes in the United States, representing $12.7 trillion in real estate value, are exposed to severe or extreme climate risks. That's flooding, wildfires, or hurricane damage. But what makes this truly alarming is that this isn't some distant prediction. This is happening right now, today. In 2024 alone, the United States faced 27 natural disasters that exceeded $1 billion in damages each. Think about that for a second. $27 billion disasters in a single year. And we're not just talking about property destruction. We're talking about the fundamental reshaping of where Americans live, where money flows, and what your home will be worth in 10 years. The numbers are staggering. The total value of residential real estate in America is approximately $50 trillion. That's nearly double the entire US GDP. Now imagine what happens when a significant portion of that value becomes questionable. Insurance companies are pulling out. Lenders are getting nervous. And homeowners are starting to panic. First Street Foundation, a climate risk research company that uses advanced climate science and engineering data, projects that by 2055, just 30 years from now, approximately 84% of all U.S. census tracts could experience some form of negative property value impact from climate risk. That translates to a staggering $1.47 trillion in net property value losses. But here's where it gets even more interesting. This isn't playing out uniformly across the country. The patterns are clear, concentrated, and devastating in specific regions. Florida, Louisiana, Texas, and California, the states that have attracted millions of Americans over the past decades, are bearing the brunt of this crisis. In Miami alone, homeowners are now paying insurance premiums equivalent to 3.7% of their home's market value annually. That's the highest ratio among the nation's 100 largest metropolitan areas. For perspective, that means, on a $400,000 home, you're paying nearly $15,000 per year just for insurance. And that's if you can get insurance at all. State Farm, one of the nation's largest insurers, stopped writing new home insurance policies in California entirely. Other companies are following suit, leaving entire regions in what experts are calling an insurance desert. This isn't just an insurance problem anymore. It's a fundamental threat to the American homeownership dream. The question everyone should be asking is simple. What happens to real estate values when insurance becomes unaffordable? What happens when whole regions become uninhabitable? And perhaps most importantly, where are all these people going to go? If you want to understand what climate-driven real estate collapse looks like, look at California. The state is experiencing an unprecedented wildfire crisis that's fundamentally altering property values and community dynamics in ways we've never seen before. In 2024 alone, California experienced over 8,000 wildfires. These fires burned approximately 1,050,012 acres and destroyed 1,716 structures. But these numbers don't capture the full picture. The economic damage was massive, $50 billion in 2024. Then came January 2025. The Los Angeles wildfires of January 2025 represent one of the most destructive and expensive fire events in the region's history. Over 57,000 acres were scorched. More than 1,600 structures were destroyed. And the damage is estimated at approximately $135 billion. Yes, billion, with a B. $135 billion. But here's what's happening beneath the headlines, and this is crucial. The real estate market response is revealing something profound about how the market perceives long-term climate risk. Research from UCLA Anderson School of Management examined historical wildfire-affected zip codes in California going back to 2000. They looked at areas hit by major fires like the Woolsey Fire in Malibu, the Thomas Fire, the Tubbs Fire, and most importantly, the Camp Fire in Paradise. What they found was striking. After a major wildfire, most areas saw median home prices decline or stagnate for 2 to 3 years. In Malibu, for example, prices fell by 11% in the 2 years following the Woolsey Fire. But then, in most cases, prices eventually rebounded and exceeded their pre-fire levels within 5 to 7 years. However, and this is the critical caveat, there's an outlier that tells the real story. Paradise, California, devastated by the 2018 Camp Fire, never recovered. This divergence is revealing. Paradise became a symbol of what happens when a fire is so catastrophic that it destroys not just homes but community infrastructure, social networks, schools, and local economies. The psychological impact of rebuilding in a place that literally burned to the ground changes people's calculus. But there's another crucial element happening in California right now. Insurance is disappearing. Major insurance companies canceled hundreds of thousands of policies in California. Many homeowners are being forced onto the FAIR plan, the Fair Access to Insurance Requirements program, which serves as an insurer of last resort. These plans are expensive, limited in coverage, and they act as a massive red flag to potential buyers. And the ripple effects are enormous. When disaster displaced residents flood rental markets in surrounding areas, rents spike dramatically. After the recent LA wildfires, some parts of Los Angeles saw rents jump by more than 200% in just 2 weeks. That's illegal price gouging, but it demonstrates the desperate scramble for housing when large populations are suddenly displaced. What's happening in California isn't just a real estate story. It's a preview of what's coming to other parts of America. As wildfires expand their season, now starting earlier in spring and lasting into late autumn due to climate patterns, more regions are entering this danger zone. While wildfires devastate the West, flooding is reshaping the entire coastal and low-lying regions of America, and the economic implications are just as severe, if not more so. Flooding is the most pervasive climate risk affecting American homes. Approximately 6.6% of all homes, worth $3.4 trillion, face high or severe wildfire risk. But here's what's particularly insidious about flooding. It's not as dramatically visible as a wildfire. Your house doesn't burn down in a day. Flooding happens gradually, repeatedly, and it erodes both property values and insurance availability. New Orleans is the poster child for this phenomenon. The city has faced massive flooding risks for decades, and the research shows exactly how that translates to reduced property values. When you compare New Orleans to nearby cities like Baton Rouge and San Antonio, the trend is undeniable. New Orleans, facing chronically higher flood risks and insurance premiums, has experienced substantially lower home price growth compared to other cities in the nation over the long term. This pattern is repeating across the country. In coastal Florida, Cape Coral, Miami, Tampa, Jacksonville, we're seeing insurance crises that are forcing homeowners to make impossible choices. Some homeowners are paying $7,000 per year for flood insurance alone. When you add hurricane deductibles that can exceed $20,000, home ownership in these areas is becoming financially untenable for middle-class Americans. The research reveals something terrifying. Properties exposed to flood risk are overvalued by between $121 billion and $237 billion, depending on which discount rate you use. In other words, the market hasn't fully priced in the true cost of living in flood zones. When that repricing happens, and economists believe it is inevitable, we're looking at a potential market correction that could rival the 2008 financial crisis, but this time it will be geographically concentrated in specific regions. What makes flooding particularly damaging to real estate markets is the cascading effects. Homes get damaged, insurance becomes unavailable or prohibitively expensive. Homeowners start defaulting on mortgages because they can't afford the total monthly payment. Mortgage plus insurance, plus rising taxes to fund local infrastructure repairs. Lenders lose money. Banks tighten lending standards in affected areas. Property values drop further. And suddenly, entire neighborhoods spiral into decline. First Street Foundation estimates that foreclosures spike by 40% among damaged homes following flood events. And crucially, many of these properties are uninsured, especially those outside FEMA's official special flood hazard areas. This means many homeowners absorb the entire cost of disaster recovery themselves. The 2024 hurricane season demonstrates this perfectly. In Florida's Lee County, Hurricane Ian destroyed 10,000 homes in 2022. Yet home prices in that county rose 70% in 2021 and 2022. compared to the 40% national average. This seems contradictory until you understand what's actually happening. Wealthier individuals are still buying in desirable coastal areas, but insurance costs are creating a bifurcated market where only the wealthy can afford to live in high-risk coastal zones. Meanwhile, flooding isn't just a coastal problem anymore. It's spreading inland. Atmospheric rivers, concentrated bands of moisture that dump massive amounts of rain inland, are becoming more frequent and intense. States like Pennsylvania, New York, and even parts of the Midwest are experiencing unprecedented flooding events. One of the most revealing statistics comes from research showing that when homeowners are presented with clear flood risk information, home values immediately decline. A randomized experiment showing 17.5 million potential homebuyers' publicly available flood risk scores revealed that homes with higher flood risk sold for approximately $7,000 less on average. That experiment influenced $135 billion in hypothetical transactions. Think about that. Simply providing information about risk decreased property values. Imagine what happens when the entire market fully internalizes that risk. The real estate crisis isn't just about property destruction or even risk perception. It's about the cascading financial crisis building in the insurance and mortgage sectors. And this is where the system starts to break down in ways that could trigger a broader economic crisis. Insurance premiums are rising at an alarming rate, and the trajectory is unsustainable. From 2013 to 2022, insurance as a percentage of total mortgage payments more than doubled, rising from 7 to 8% to over 20%. That's not gradual inflation. That's a fundamental shift in the cost structure of home ownership. Looking forward, First Street Foundation projects that if risk-based insurance pricing is allowed to operate without restriction, average insurance premiums could increase by 29.4% by 2055. But that's the average. In specific metropolitan areas, the numbers are catastrophic. Miami is projected to see insurance premium increases of 322%, Jacksonville 226%, Tampa 213%, New Orleans 196%, Sacramento 137%. These aren't theoretical projections, they're based on actuarial models and current trends. What does a 322% insurance increase mean in practical terms? It means that in Miami, homeowners could be paying insurance premiums that rival or exceed their mortgage payments. At that point, home ownership becomes economically irrational. Nobody makes that math work. And here's where it gets truly dangerous. Mortgage lenders are starting to realize that properties in high-risk areas might not be sound investments over a 30-year loan period. If a property is facing increasing insurance costs, recurring flood damage, and declining resale value, why would a lender put 80% of their capital at risk? First Street estimates that if 2025 turns out to be a particularly bad year, and it began with the devastating Los Angeles wildfires, lenders could lose up to $1.2 billion in weather-driven mortgage foreclosures. By 2035, that number is expected to grow to $5.4 billion annually. These are stunning figures. Florida, Louisiana, and California alone are projected to account for 53% of all climate-related mortgage losses in 2025. The main culprit is flooding, which is identified as the leading climate driver of foreclosure risk. The mortgage lending industry isn't blind to this. Fannie Mae and Freddie Mac, the quasi-governmental entities that underpin the entire U.S. mortgage market, are now integrating climate risk into their securitization processes. This means the mortgage-backed securities market, which is fundamental to housing finance, is starting to reprice climate risk. When that repricing happens at scale, we could see a significant tightening of mortgage availability in high-risk regions. Banks might demand larger down payments, charge higher interest rates, or simply stop lending in certain zip codes entirely. This creates a vicious cycle. Properties become harder to finance, so values decline further, making the risk even worse. We've also seen major insurance companies simply exit entire markets. State Farm stopped issuing new policies in California. Other carriers are following suit. This isn't just California either. Across the country, insurance carriers are becoming more selective, more expensive, and more likely to exit markets where climate risk is too high. When insurance becomes unavailable, homeowners become uninsurable. When homeowners are uninsurable, banks won't lend. And when banks won't lend, real estate markets collapse. This is the silent collapse we're witnessing. The federal government is trying to prop up the system. FEMA disaster assistance, SBA disaster loans, and various state programs are all attempts to prevent catastrophic market failures. But government resources are finite, and the scale of disaster is growing exponentially. The most profound impact of this climate-driven real estate crisis isn't measured in dollars or damaged homes. It's measured in migration. Millions of Americans are on the move, and their destinations are creating entirely new patterns of property value appreciation and decline. Here are the numbers. Over 55 million Americans are projected to voluntarily relocate within the United States to areas less vulnerable to climate risks by 2055. That's starting with 5.2 million people relocating in 2025 alone. That's approximately 1.3% of the entire U.S. population moving due to climate concerns annually. To put this in perspective, that's equivalent to the entire population of Colorado moving every single year for the next 30 years. It's an unprecedented migration pattern. Interestingly, the current data shows something contradictory that economists find fascinating. Despite massive climate risks, Americans have historically been moving into high-risk areas, not out of them. This has been the trend for decades: migration to the Sun Belt, to coastal areas, to California. Most flood-prone counties gained 384,000 residents between 2021 and 2023. Counties facing the greatest wildfire risk gained 426,000 net residents. Drought-prone metro areas saw net inflows in 25 of 34 regions studied. In other words, people have been actively moving into disaster zones. Why? The answer is complex. First, these areas offer affordability. Arizona and Nevada remain relatively affordable compared to overheated coastal markets. Second, they offer quality of life and amenities. People want to live in warm climates near the ocean or in scenic mountain areas. Third, and this is crucial, many homebuyers simply don't have full information about climate risks. In 23 states, home sellers aren't required to disclose a home's flood history. Only 2 states, California and Oregon, require any disclosure of fire risk. But there's a shift happening. Recent data from November 2024 shows, for the first time in over a decade, that homes with low natural disaster risk are rising in value faster than homes with high risk. This suggests that the market is finally beginning to properly price climate risk. As awareness grows and information spreads, the migration patterns are expected to change. The destinations for climate migration are becoming clear. Areas with low natural disaster risk are attracting capital and population. Dane County, Wisconsin, for example, is projected to see long-term positive property value impacts as migration accelerates. The Midwest is becoming the new destination. Regions with low flood risk, manageable wildfire risks, and historically stable weather patterns are seeing increased migration. This is going to create an unprecedented geographic reordering of American prosperity. But here's the dark side of climate migration that economists call climate gentrification. As wealthy Americans flee coastal and western cities due to climate risks, they bring capital to relatively affordable but climate-safer areas. This drives up property prices in those regions, pricing out local populations. You're essentially seeing a second or third migration wave. The climate migrants' arrival displaces the original residents, who can no longer afford the rapidly appreciating homes. This has massive implications for inequality. Low-income households are far more vulnerable to the negative effects of climate-driven property value depreciation because they have less equity and less ability to absorb losses. Meanwhile, wealthy households can afford expensive insurance, can afford to relocate before property values crash, and can absorb short-term losses knowing they'll recover over time. Some regions are experiencing both effects simultaneously. In areas like rural Texas or small towns in the Midwest, you're seeing climate migration create demand and property appreciation. But in coastal Florida and California, you're seeing the simultaneous exodus of people priced out of climate disaster-impacted regions, moving inland and competing for housing in safer areas. The housing shortage in safe, climate-resilient areas is becoming acute. Building codes are stricter in these regions, land availability is sometimes limited, and infrastructure can't keep pace with demand. This creates secondary real estate crises in the destination regions, affordability crises driven by climate migration rather than by traditional urbanization pressures. When you analyze the data on climate change and real estate at the neighborhood level, not the metropolitan level but the actual census tracts where people live, an interesting pattern emerges. First Street Foundation's research identifies 5 distinct trajectory categories that neighborhoods are falling into. First category, climate abandonment. This represents 26% of all U.S. census tracts. These are neighborhoods where climate risks are severe enough, insurance is expensive enough, and property values are declining enough that people are actively choosing to leave. These neighborhoods will likely become increasingly depressed, with declining populations, reduced tax bases, and shrinking municipal budgets. Second category, risky growth. This is 31% of census tracts. These are areas that have been traditionally growing and remain attractive for other reasons: job markets, cultural amenities, family connections, but where climate risks are visible and growing. These neighborhoods are in a precarious balance. For now, they're still growing, but growth rates are slowing. Property value appreciation is below historical norms. These are neighborhoods where the warning signs are flashing. Third category, tipping point. These represent 27% of census tracts, and this is the truly dangerous category. These are neighborhoods that are currently economically strong, they're growing, property values are appreciating, but they're approaching a threshold beyond which the climate risk becomes so severe that migration reverses. Imagine a thriving suburb outside Miami or Tampa. Everything seems fine, but then insurance costs triple. A few major flood events happen. Suddenly people start leaving. Property values that were rising start declining. The positive feedback loop reverses into a negative one. When that tipping point is crossed, it's hard to stop the decline. Fourth category, economic decline. This is 11% of census tracts, neighborhoods that were already economically weak and are being hit additionally by climate risks. These are the most vulnerable communities. They have fewer resources to adapt, lower property values that can't decline much further, and populations that can't afford to relocate. Fifth category, climate resilient. This is only 5% of census tracts. These are the neighborhoods that will emerge as winners. They have low climate risk, they're attracting migrating populations, and they're experiencing property value appreciation. These will be America's most desirable communities for the next 30 years. The distribution of these categories reveals something sobering. 84% of all American neighborhoods will experience some form of negative property value impact from climate risk by 2055. Only 5% will be true winners. But here's what makes this timeline so critical. The transition between these categories isn't linear. It's not like values gently decline year after year. Instead, there are often tipping points where perception shifts, and suddenly the market reprices. A neighborhood that looked stable for 5 years can suddenly experience a 15% value decline in 12 months once the market shifts its perception of risk. We've seen this before. After Hurricane Sandy in 2012, neighborhoods in New York City that were directly affected saw property values drop, recover partially, but never fully recover to pre-Sandy levels. 5 years after Sandy, homes in flood zones, even homes that weren't directly damaged, were selling for less than similar homes on higher ground. And this discount persisted. But markets are efficient over long periods. Real estate is repricing climate risk more aggressively now than it was even 5 years ago. And as more data becomes available, as more catastrophic events occur, and as insurance companies become more selective, that repricing will accelerate. We're likely to see significant neighborhood-level property value collapses in specific regions, particularly coastal Florida, Louisiana, and parts of California, within the next 3 to 5 years. Not gradual declines, actual collapses. The kind that trigger foreclosures, force sales, and create a feedback loop of decline. So what's the end game here? Where does this all lead? First, we're heading toward a fundamentally fractured real estate market. Properties in high climate risk areas will become bifurcated into 2 categories: Either very expensive properties owned by wealthy individuals who can afford climate disasters as part of their lifestyle, or very cheap properties that are essentially distressed sales or assets abandoned by financial institutions. For example, a luxury waterfront home in Miami might still command a high price because wealthy buyers see it as a luxury good and don't mind the climate risk. But a middle-class suburban home in a fire-prone area of California, that's going to become a wasting asset. Property values will follow a consistent downward trajectory as the owners realize their biggest asset is becoming a financial liability. This creates a housing affordability crisis that's inverted from traditional housing crises. Instead of homes being too expensive, homes in certain regions will be cheap because nobody wants to live there. This might sound good, but it's actually catastrophic for the existing residents who bought those homes expecting them to appreciate as long-term stores of wealth. Entire communities built on the assumption that property values always go up will collapse economically. Second, insurance will completely reshape the financial structure of homeownership. In high-risk areas, insurance costs might eventually exceed mortgage payments. This means the total cost of homeownership becomes astronomical. Homeowners will face choices: sell and leave, default on the mortgage, or try to survive with ruinous insurance costs. Insurance deserts will expand. Government-backed insurance programs will become more important, but they'll be underfunded and overwhelmed. Third, there will be a massive wealth transfer from climate-vulnerable regions to climate-resilient regions. Homeowners in high-risk areas who were counting on property appreciation for retirement will see their wealth evaporate. Simultaneously, homeowners who flee early to safer regions will capture appreciation in those areas, essentially trading worthless equity in climate-risky areas for valuable equity in climate-safe areas. Fourth, government intervention will become inevitable. We'll likely see federal policy changes around disaster insurance, lending standards in climate-affected regions, and possibly direct property buyout programs. The federal government will be forced to choose between propping up real estate values in catastrophically affected regions or allowing market forces to work. Either way, massive amounts of public money will flow to address this crisis. Fifth, municipal finances will collapse in affected regions. As property values decline, property tax revenues decline. This forces municipalities to raise tax rates, which further reduces incentives to stay, which further reduces property values. Public services deteriorate. Schools become underfunded. Infrastructure maintenance is deferred. Entire regions spiral into economic decline. The positive scenario? In climate-resilient regions, you're going to see genuine economic boom conditions. Lower insurance costs, abundant housing supply from migrating populations, and strong property value appreciation create virtuous cycles. These regions, parts of the Midwest, Mountain West, and North Atlantic, will become increasingly prosperous and attract massive investment. But here's the crucial point. This isn't some distant theoretical scenario. This is already happening. The data from 2024 shows homes with low climate risk appreciating faster than homes with high climate risk for the first time in over a decade. That's the market finally waking up to the reality of climate risk in real estate. The question isn't whether this will happen, it's how fast it will happen and how bad it will get. Some economists believe we could see significant regional real estate collapses within 3 to 5 years if migration patterns accelerate or if a few more mega disasters occur. Others believe the timeline is longer, 10 to 20 years, before the full repricing is complete. But regardless of timeline, the fundamental reality is clear. America's real estate market is being redesigned by climate change. Property values are being rewritten by natural disasters. Millions of Americans will be forced to migrate. Trillions of dollars in wealth will be destroyed or transferred. And the communities that aren't prepared for this transition will face genuine economic collapse. The silent collapse of American real estate isn't coming. It's already here. We're just now beginning to see it play out in insurance premiums, property value trends, and migration patterns. And as the crisis accelerates, we're going to witness one of the largest wealth transfers and regional economic reorganizations in American history. That's the story of how natural disasters are redesigning America's real estate market. It's a story written not in headlines about disasters, but in the quiet desperation of insurance premiums, the slow decline of neighborhood property values, and the desperate migration of millions searching for safer ground. Thank you for watching. If you found this analysis valuable, please consider subscribing to stay informed about the economic and financial implications of climate change. The future of American real estate is being written right now, and understanding these trends could be crucial to your financial decisions in the coming years. Before you go, let me leave you with the most important statistics from this analysis, because these numbers represent real implications for real people. The scale: 26% of American homes, approximately $12.7 trillion in value, face severe or extreme climate risk. By 2055, this could expand to affect 84% of all U.S. neighborhoods. The forecast: 55 million Americans are projected to relocate to climate-safer areas by 2055. That's roughly 5.2 million per year starting in 2025. The value at risk: approximately $1.47 trillion in net property value losses are projected by 2055 due to climate risk, with a potential gain of $244 billion in climate-resilient areas. The insurance crisis: insurance premiums could increase by an average of 29.4% by 2055, with some metro areas facing increases exceeding 300%. The mortgage impact: lenders could lose $1.2 billion in climate-driven foreclosures in 2025, growing to $5.4 billion annually by 2035. The disaster reality: in 2024 alone, the U.S. faced $27 billion natural disasters. The Los Angeles wildfires of January 2025 caused $135 billion in damage. The market signal: for the first time in over a decade, homes with low climate risk are appreciating faster than homes with high climate risk. The market is repricing. These aren't abstract numbers. They're the foundation of one of the most significant economic transitions happening right now. The American real estate market, the $50 trillion foundation of American wealth, is being fundamentally restructured by climate change. Understanding this transition isn't just academically interesting, it could be crucial to your financial future.